Welcome back to the stream, ladies and gentlemen. Butcher Wall Street here. We have some serious contagion happening right now in the real estate markets, and a lot of people wonder, what does China and their real estate market have anything to do with us here in the United States, Canada, Europe, etc.? And they fail to realize that these developers owe trillions of dollars, not millions, not even billions. I'm talking trillions of dollars in bonds and liabilities to some of the world's largest banks, including those here in the United States and around the world. You guys, of course, know that as of last year, actually in 2023, the chairman of Evergrande CEO was put under police surveillance in 2023, and he has not been seen since. He was in a special detention center in Shenzhen since 2024, and nobody has seen the guy. Not a single person. Today, we just found out that China Vanke CEO Zhu Juisheng was arrested by the Chinese government. And I don't know if we're going to see this guy for a while either, right? That may not be your biggest concern. But the fact is that all five of China's largest real estate firms are in the news this week. This is something we've been covering on this channel for a period of several years now, and we've been following it very closely. So we're going to explain to you here exactly how this contagion is going to affect people's pensions, 401ks, investments, stocks, bonds, cryptos, real estate, not only in China, but the entirety of Asia, Europe, and North America. You know, that goes for the rest of the world. This is a massive issue, and I cannot understate that. This is not some sort of gloom and doom, and I don't want you to be concerned, but you do have to be aware of what's happening, because this will be greatly affecting the United States and Canada and Europe, and I'm going to show you guys exactly how. So as you can see here, just a couple days ago, on the 13th, after a couple years of bankruptcy court now, China's Evergrande has finally been ordered to be liquidated. Yes, finally. They've been in bankruptcy court for a significant period of time. We had Dr. Marco Metzler, former Fitch Ratings director, here on this channel quite a few times, and he has been an absolute wealth of knowledge. And let's just say that his company, DMSA, a ratings agency, held bonds in Evergrande and was amongst the first to come out publicly and explain just how over-leveraged this company was and how poorly that vies for the rest of the global financial sector, particularly banking and real estate. So liquidators filed a wind-up petition against Evergrande and their subsidiaries back in September in order to recover some of the funds that they had here. They are the world's most indebted property developer, and they have over $600 billion alone in liabilities and bonds. That does not include all of their hidden debts, because in China, these companies don't have to disclose all their debts and all their loans. January of last year of 24, the court ordered it to liquidate after they failed to achieve a restructuring plan of $23 billion of that offshore debt. And now we've literally just seen them on January 13th of this year, formally by Hong Kong court, be ordered to be liquidated. There is now lawsuits against Evergrande and their auditor, PricewaterhouseCoopers, who is in hot water as well. But I'll give you a quick rundown here in case, aside from the guy being arrested, I did want to let you know that the Chinese government is going to be taking over or restructuring and declaring bankruptcy in the entirety of Vanke Group. Vanke Group is in the top 3 of real estate developers in China, and Evergrande was number 2. That being the case, we are seeing the largest companies in the world, in the largest sector in the world, just become completely obliterated, become bankrupt. These guys are going to jail for fraud, and it is going to have a cascading effect, a domino effect on the rest of the world. You can see this post here that I posted this December 3rd of 2023. I stated that China's second largest real estate developer, Evergrande, faced dissolution in bankruptcy court in December of 2023 because global banks hold nearly $1 trillion in bonds, loans, and debts of Evergrande Real Estate Company and their failed electric vehicles division. This is going to have a massive implication on the collateral and blue chip stocks that these banks hold as well, because they also have a significant number of short positions against massively shorted commodities and equities and assets such as silver, such as gold, and even meme stocks. If the bondholders, of course, they didn't accept the poor solution of taking equity in the insolvent company, Evergrande, they were formally dissolved, and all the remaining assets of the heavily indebted real estate developer will be sold off en masse, leaving as little as 0 to 5% repayment to the debtors of this basically $1 trillion. And you can see my statements here on the Ponzi that it is about time that they are gone. And for those of you that are unaware, they remained solvent due to the literal Ponzi scheme in which more new investors would needed to buy apartments from Evergrande in order to fund those that had already been ordered in the past. This is gone. This is done for. We have seen as of January 13th of 2025 that the guy has been arrested for fraud, and that Chinese Hong Kong courts have actually ordered Evergrande's formal liquidation now. Is the banks will be forced to write off $1 trillion in losses from the one developer alone. That's just from Evergrande. That does not include the rest of them. All these others that I'm talking about, Vanke, Country Garden, we'll talk about them soon here shortly, as well as what's going on here in the United States with housing and in Canada, because it's a hot mess to say the least. You know, China's been trying to bail out these guys for a long period of time. You can see here this post that I put on August 28th of 2023. China reduced their capital gains on stock trading by over 50%. Evergrande was down 87% on that day. The Chinese government has ordered state banks and funds to buy stocks to boost their markets. Global banks and crypto exchanges like Tether hold a massive amount of Evergrande bonds, as is the contract collateral at the original historic value. If that is taken into account here at the mark-to-market value, they're going to have serious issues. Evergrande filed Chapter 15 bankruptcy to prevent international banks from pursuing repayment of the nearly $1 trillion in losses. You guys have seen what that's been. I did also stated that upon bankruptcy, whenever that may be, now 2025, that's coming to fruition, these bonds and commercial notes will become 100% worthless. They had already lost the vast majority of their value. Now they're going to lose the rest of it. So they will not be able to be used as any form of collateral as well. Of course, they can't sell them because nobody will buy the bonds. And that is proven heavily here in the Vanke bonds as well. As I can show you guys that today, trading in Vanke bonds fell sharply as all of their bonds fell from 2020, the 21 Vanke, 22, all of these were basically just collapsing between 11 and 27%, and they're no longer currently tradable as they have been halted. Blue chips, real estate, and crypto are highly likely to see a massive correction due to the need for these banks to maintain collateral in their heavily shorted equities as well. And you see here that they have been formally ordered to liquidate. Let's talk about Vanke real quick so you guys can understand what's going on there. Thank you, Darktown. Don't forget to drop a like for the stream so that other investors can find this information as well. Woody in the chat says worthless pieces of paper equals margin requirements need to be met. And that's the big problem, that short interest is highly speculative and is greatly suppressed and hidden by a lot of these firms because it is often marked incorrectly as an asset instead of a liability. As you guys would know if you've been watching this channel for a while, we talk about the SEC charges against these firms all the time. So yeah, China Evergrande is currently in liquidation. They received their liquidation orders and a winding up petition against their subsidiary, Tianji Holdings, to March of 2025. Their shares, the trading of their shares is suspended. Stakeholders are urged to exercise caution, of course. because this is it's going to zero. It's already near there, and it's going to zero. The Vanke CEO was taken away by Chinese authorities, and they are one of China's top 5 property firms. They are partially owned by the Shenzhen government. They are the 4th largest real estate firm in China by sales last year. They were the 2nd largest the year before. They have, of course, faced massively and significant financial challenges here. They posted a net loss this year of over $1.5 trillion last year, and just in the first half of 2024 alone, because people are not buying their garbage homes. There are no formal detention or allegations on what charges he's facing in Vanke. However, we do know this. This man by the name of Desmond posted this on Twitter, and I really want to share this with you guys because he says, if Vanke is dying, every Chinese developer should already be dead. For a very long time, Vanke has been considered the best managed developer in China. And as a former developer myself, and speaking of Desmond, I personally am also a former real estate broker. I agree with what he's saying, and he agrees with their assessment. He continues to say Vanke has consistently demonstrated competent management and delivered products that are decent for their price point. Vanke's CEO first issued a stark warning about the industry back in 2018, declaring the company's primary goal was simply to stay alive. At the time, his pessimism shocked the industry, and it was an unusual admission from a leader of a firm that had long been a symbol of stability in China's property sector. Literally today, Vanke stock is trading at 4.7 HKD, which is an 82% drop in value. Let's put that's somewhere in the range of like 20 cents US dollars if I had to guess. Worse still, their May 2025 bond is trading with a 63% yield to maturity, and the 27 bond is priced at just 48% of face value. Essentially, the market no longer believes that Vanke can remain solvent, and this continues to be an ongoing concern. He says, in my opinion, every Chinese developer is effectively dead. Dead as a viable business model and dead as a solvent company. They are rightfully claiming assets. They are surviving only because the Chinese government prevents creditors from rightfully claiming assets when companies default. While the property market has been in a state of free fall for the past 3 years, I believe we are still in the early stages of this unraveling. The government continues to attempt to revive the market. You guys saw that clearly from what I just showed you from what's going on in 2023 and 2024. And many homeowners still hold on to the hope that conditions will improve. But developers know better. They fully recognize their fate is sealed, and they are merely playing along with the government's messaging to extract whatever they can from the current situation. The most critical issue, however, is the broader economic impact of the real estate collapse. The wealth effect associated with plummeting property values is only beginning to ripple through the economy. The full consequences of this collapse will likely play out over the coming years, with far-reaching effects on economic growth, social stability, and ultimately political stability. This has been something that's been ongoing for quite a significant period of time. And it is definitely accelerating, to say the least. To give you a little bit more insights on how bad this is, I posted in 2024 that more than a dozen top Chinese executives have gone missing. Of course, the bankruptcy hearing for Evergrande was delayed, and now, as of just a couple days ago, liquidation is guaranteed as it's been enforced by the Hong Kong courts. The creditor group firmly rejected their proposals for a majority controlling interest in Evergrande, and the CCP banks have dumped over $507 billion US dollars through last year alone into the top 100 real estate developers in the last several months to delay the collapse of their markets. China whitelisted over 50 more developers to receive an additional 180 billion US dollars in more loans, and still those measures, of course, have failed to reverse the slumping real estate sector. You can see that I posted this December 3rd of 2023. And though they continue quantitative easing and printing shitloads of money to bail these real estate developers out and these firms out, It's not enough, and it will never be enough. The prices of homes in China declined at the fastest level in 9 years and fallen for the last 5 months consecutively. Now that's closer to 15 months. Two bank executives in Zhongzi Bank went missing after the CCP launched a federal investigation into illegal crimes at the shadow bank. And global banks own bonds in Evergrande, Country Garden, Vanke, and all of the top developers. And in Evergrande alone, there was over $1 trillion worth of debt, liabilities, and bonds. Does this mean financial collapse this week? No. As I stated in 2023, this is going to be an ongoing situation. It will draw down on the rest of the country and economies worldwide as we enter a global recession. Liquidity is ever tightening. All of the banks are interconnected via these liabilities, leading to market volatility and potential margin call situations on heavily shorted equities and assets. And of course, when central banks print more money to bail out these banks through loans, repo operations, and after the RRP is drained, the reverse repo operations, this will cause even more inflation while the global economy stagnates, leading to stagflation. Of course, I posted this today, just moments ago, because at 12:15 today, we found out that the Federal Reverse Repo operation usage in the United States by mutual funds, by money market funds, has completely collapsed. Excuse me one second. All right, as I was saying, yeah, that's right, King. Huge shout out to Typo Negative. You are too kind, my friend. Really appreciate you. The Federal Reverse Repo operations were at a high of $2.5 trillion just a year and a half ago. Now we're looking at $94 billion today. Yesterday was 116 or so. There it is. Yesterday was 119. And the day before that was around 160. In case you didn't know, the reverse repo market crashed and was bailed out by the Fed on September 17th of 2019, when the SOFR rate increased from 2.4 to 5.25 to over 10% in a matter of 2-3 days. The Federal Reserve had to bail it out and spent $75 billion every day for a week, bailing out money market mutual funds and banks as nobody was willing to lend. Economists identified that this crash was due to a shortage of cash available in the financial system. And what we're seeing right now is that the United States Treasury is issuing hundreds of billions of dollars in bonds every week or two, basically every week. They did $200 billion on the 14th, $200 billion more today. They're going to do $200 billion more on the 21st. Sorry, no, hundreds of billions more on the 21st, probably $400 billion or so, and so on. This will continue to draw down the liquidity available in the reverse repurchase operations through the Federal Reserve. And of course, this means less liquidity in the system. All in all, when the money market funds are no longer buying U.S. Treasury bonds and Treasury bills, then the United States government and the Fed are going to be buying their own bonds, much in the same way that Japan has been buying theirs for years. We are looking at what Dan here says in the comments. The deep state is going to crash the market on Trump. That's looking very, very likely in the in the near to midterm future here. Let's move on. Of course, as I was telling you guys, Evergrande was fined $577 million for misconduct. The founder was fined $6.5 million, banned for life from participating in securities markets. Stagflation abound. Now let's take a look at property. Before I talk about U.S., also wanted to mention Country Garden. Of course, they're also going through bankruptcy court right now. Their stock is suspended from trading. And another one of their massive developers is likely to collapse as well. You can see here, this post was from April 2nd of 2024, in which I posted that China's number one real estate developer, Country Garden, faced liquidation bankruptcy court. Their stock suspended from trading. I said at the time that Vanke shares hit an all-time low as profits plummeted 50% year over year. Is the banks, of course, no longer going to be able to use the Country Garden stocks or coupons as collateral if forced liquidation occur? The Ponzi schemes in China are collapsing at a record pace. You get the idea. All right, let's talk about the United States here. The delinquency rate of multifamily housing. This is a really good thread. We spoke about this very in depth yesterday, but it looks like this guy just posted this today. So we're going to just piggyback off his thread so you guys can check out these charts. Look at the delinquency rates for multifamily housing in Freddie Mac. Multifamily housing means, of course, anything that's a duplex, a triplex, apartment buildings, etc. They are at levels that we have not seen since the collapse of 2008. Of course, check out the Fed hiking cycle. What's happened? The federal funds rate, the Fed have cut rates. However, unlike the Fed cuts, mortgage rates are increasing. They are the highest they have been since 2023, currently at around 7.5% for 30-year mortgage rates. Homebuyer affordability has fallen to the lowest levels we've seen in 35 years. Mortgage demand has plummeted to levels we have not seen since 1995, ladies and gentlemen. The unaffordability and high inflation put massive pressures on consumers, who of course are defaulting rapidly on their investment homes first, and then eventually on their single-family homes. The last time that buying conditions have collapsed to the current levels has only occurred 2 times since 1960, and that's 1974 and 1981. We are already in a recession, but the numbers are being hidden by the Biden-Harris administration. But if a recession is officially called next year, that would be another major headwind for the consumers and the housing sector here, says Bravos Research. But of course, we're already there. These gray bars will be filled in after the fact, just like they were on every other recession we've seen. Take a look at the mortgage applications. We talked about this briefly yesterday. From 1990 to 2025, the housing market is frozen. Mortgage demand has fallen to the lowest level since 95, according to Reventure Consulting. Since the peak, less than 4 years ago, U.S. mortgage applications are down 63%. Again, they're talking about the amount of income needed to buy a house versus median income. Now that's increased by over 50% over the last 4 years. 100% increase in 4 years, thanks to the Biden-Harris administration. Here's the peak of the 2006 housing bubble. The difference was around $10,000 or 2.6 times less. The gap between income needed to buy a home and annual income has never been larger, says the Kobesai letter. This means that housing payments as a percentage of median income are now higher than 2006. What do you think happens next, ladies and gentlemen? Existing home sales are at the worst that we have seen since 1995. Just like mortgage applications, at the worst we've seen since 1995. The sales in 2024 were even lower than 23. The entire 2 decades before that, We're basically going back 3 decades since we've seen housing this bad, with the sole exception of 2008, which was even still better than it is right now. Of course, this aligns with the sharp drop in mortgage demand, as we just said, and they're saying here as well. We're seeing high interest rates. The Federal Reserve is cutting interest rates, but mortgage rates are increasing, and bond yields are increasing as well. Bond yields increasing are bad because that means that the payout for bond coupons is reduced. Obviously not good. The median new home sold for $417,000 in the United States, while the median existing house sold for $419K. Something is wrong when a new house is less expensive than an old house. And I'll explain to you guys here. As a former real estate broker myself, I can promise you that I know a lot of the way that these builders are structuring these deals. They're not reducing the purchase price on these. They're giving down payment assistance. They're buying down the people's interest rate for a couple of years. They are giving other incentives on the back end in order to keep the housing prices elevated. That's the only reason that new home prices are not lower than they currently are. They're doing everything they can to give deals on the back end of the table here, under the table deals, to prevent the house price from being lower than it is currently right now. And that is artificially propping up housing prices as we speak. This will not last forever. It is an inevitability that this also collapses. A lot of people are out there telling you that we're not going to have a housing crash because we don't have the subprime crisis of 2008. Well, newsflash for you guys. Subprime loans in 2008 were less than 15% of all loans. It was the speculation that was going on. The speculation that was going on in 08 that caused a lot of the issue. And now we're seeing that very same speculation through Airbnb and VRBO rentals. As individuals are no longer able to maintain their portfolio profitably or even breaking even, they're going to be forced to sell off some of these properties through under-the-table deals. Under-the-table deals are happening right now, left and right. There are more under-the-table deals happening with people selling their listings, their Airbnbs and VRBOs, to institutions that you don't see. And because they don't hit the MLS, that is artificially preventing the price of homes from going down. It will happen. It is an inevitability with the cases that we're seeing now across the world, from China, Canada, and the United States. Of course, as you can see here, buying a home today versus 2021 would cost you basically 63% more in 4 years. The CPI data that came out yesterday showed that shelter inflation is still high at over 4.6%. Rent inflation is high, continuing at 4.3%, and homeowner inflation at 4.8% year over year. Of course, it is currently having a downtick right now, and will see a resurgence, as we've seen already begin, unless there is a massive recession or depression, much greater than what we're currently seeing right now. And it's becoming more and more likely that that actually becomes the case. Now, I'm sorry to be the bearer of bad news, folks, but this is also coming to Canada. Look at Toronto. These are new condominium sales, apartments for those of you in New York. New apartment sales, new condo sales for the rest of us. The Toronto housing market is on the brink of disaster. Check that out. And where do these numbers go back to? Look at that. 1995. Very similar to what I just showed you guys is going on right now with mortgage applications in the United States and home sales, existing home sales in the United States. 4.04 million homes were sold in 2024, the worst year since 1995 in the United States. Mortgage applications are at levels we have not seen since 1995. And look at Canada. Toronto's housing market is on the brink of disaster. New condo sales plunged a staggering 78% from the 10-year average. An absolute free fall. 78%, ladies and gentlemen. This is ground zero for the coming housing collapse. We're seeing in the United States, Canada, Europe, and Asia. We are entering a massive correction here, folks. I cannot tell you exactly how you should prepare for this, but I will tell you that you need to make sure you're properly hedged. There are a variety of tangible assets and other investments outside of real estate that you could look into. Even things such as canned food to prevent from having to pay higher prices in the future would be a good tangible asset. Heavily shorted precious metals like silver and gold are in incredibly high demand by central banks. And historically, over 96% of all precious metals derivatives trades, that means options, futures, etc., by big bank institutions and central banks, take place in dark pools because they use dark pools in order to artificially manipulate the price of silver and gold. SLV, the silver ETF, back in 2021 was made position close only, along with other stocks like GameStop, AMC, COS, and over 50 different securities, all of them heavily shorted equities. And commodities, of course, since silver is one. And they had to, broker dealers, stock brokerage firms, hedge funds, family offices had to do so in order to maintain their solvency. But that's not something that's likely to continue in the future, especially not under the Trump administration and the new Securities Exchange Commissioner, Paul Atkins. As we've also seen that nickel trades have been reversed. Massive nickel trades have been reversed in the past. Yet again, more metals that are being manipulated. However, what we're seeing now is not just the potential for a short squeeze. We're seeing everything line up for a massive collapse in the housing market, in real estate, and in stocks and equities, blue chip stocks and equities around the world, because they're all interconnected. How to put this? Simply, make sure that not all of your money is tied up in one place. The stock market has been rip-roaring this year. Well, should I say last year, since this year it's beginning to already see a correction in 2025. Cryptocurrency is ripping higher. God bless all you that are in heavily shorted cryptos like XRP and some others that are doing very well right now, over $3 per token per crypto for XRP. Huge shout out and props to all you retail investors that are holding XRP as well. Nothing lasts forever. Let's put it that way. And eventually, there has to be a correction in the overinflated bubbles that we're currently seeing in housing, stocks, crypto, bonds, and many other asset classes. There, of course, are some that run inverse to the market, sometimes with the market, and then oftentimes inverse to the market, like silver and gold. In 2008, in the great financial crisis, silver and gold pulled back along with the collapse of the stock market and then soared high silver to over $50 an ounce, gold to new all-time highs. And it happened way before the stock market recovered because they were fleeing. People and institutions were fleeing from stocks into safe havens that protected them from inflation and stock market losses. That's very similar to what we're going to see in the near future when there is a correction in stocks and cryptocurrencies. Crypto is great, but there's no company there. You're not invested in a company. You're invested in a speculative asset class that only holds demand when everything is fine and dandy in the world. When that changes, then people want something they can put their hands on. They want something they can go to the store and buy food with, something they can buy a house with, something they can buy a car with. Gold and silver. They want something that has longevity outside of the stock market, like private equity investments. That being said, you should look into Lit Exchange. There's a link down in the description for litexchange.com. For the last 39 months, my partners and I have been working and developing a stock and crypto brokerage firm that is set to launch here in late 2025 or early 26. And you have the ability, for the first time in the world, to ever invest in an upcoming stock brokerage firm before launch and the planned IPO. When we eventually IPO in the coming years, you will, of course, have the opportunity to have a liquidity event. If you don't know what that means, it basically means sell your shares of Lit Exchange that you purchased for a fraction of the price several years ago. Typo negative brings up a great point. No electrical grid, no internet, no crypto, bro. Yeah. Collapsing housing, collapsing bonds. Well, probably collapsing stock market and collapsing crypto. They will all go hand in hand. Cryptocurrency is not safe from the dangers of the stock market, sadly. And one of the beauties of Lit Exchange is that we're going to be routing orders automatically to lit markets, meaning that those dark pools that banks are using to manipulate your shares and your trades in precious metals and equities, ETFs, well, they won't be able to do that when your orders aren't going to the wholesalers like Citadel and Virtue and Susquehanna and State Street. Those market makers will not be able to front run your trades and suppress your orders in their dark pools. King Salmonfish says they're absolutely 100% going to give up and release my gold to me. You know what, my friend? I hear where you're coming from. The problem is that there's not enough silver and gold in the world, not by a long shot, to deliver on all the paper, silver, and gold that is out there. There's way too many exchange-traded funds and products and paper derivatives of precious metals to ever be able to deliver people a fraction of what would have to be delivered if people started to exercise some of their contracts or exercise physical delivery of their PSLV, for example, Sprott Physical Silver Trust or SLV. That's why actual physical metals are king. And at the same time, when blue chips are being sold off, much like we saw in 2008 with Volkswagen, heavily shorted equities tend to rise to new all-time highs. We've seen that happen in the past, and for the most part, these stocks like Volkswagen, SLV, GameStop, AMC, run with the market. When shorts get margin called, well, you've seen what's happened with Archegos, Credit Suisse, Melvin Capital, and hundreds of other firms. Citron Capital of Andrew Left, who is facing 370 years in federal prison with charges against him by the DOJ and Securities Exchange Commission for manipulating markets and trying to short sell GameStop and AMC illegally. Now you guys just saw yesterday Hindenburg Research has announced that they are shutting down. Gee, I wonder why. I will leave this video there as I don't want it to get too convoluted and it's already long enough as it is. Make sure you're properly hedged. If you want to look into a mid to long-term investment, check out litexchange.com. You can sign up there with your email address for free updates if you'd like to be a part of the company, or if you just like to use our software and assets once we go live. That is your choice. But you can, for a small investment, become a founding member of the company and receive a ton of perks and benefits. Naturally, investing of any kind comes with risks. So we have done all of our due diligence. I expect you to do all of your due diligence. And we have put all of our audited financials, business plan, pitch deck, and everything else on the FINRA regulated funding portal, Silicon Prairie, for your review, and have filed all of the necessary filings with the Securities Exchange Commission EDGAR system. And you can find that at litexchange.com down below in the description. Cheers.